Hello, this is Harold Gatlin. Thank you for joining today for our 2014 mid-year update and outlook. In this call, Troy Patton, one of our portfolio managers and president of Archer Investment Corporation, will discuss the first half of the year as well as the outlook for the remainder of 2014. Along with being a portfolio manager, Troy is a CPA as well as an accredited business valuation expert. Without further ado, welcome, Troy, and please give us all your thoughts on the year so far.
This is the Archer Investment Corporation 2014 mid-year update and outlook. And I wanted to just introduce myself again with Archer Investment Corporation. We are a national registered investment advisory firm, an SEC RIA firm that uses CPAs throughout the country and different investment advisor representatives. We work with them to help them manage assets for their clients. Again, this presentation is designed to be educational. It is not a sales pitch. We do this twice a year, giving our annual outlook and then our mid-year outlook. So without further ado, I'm going to go ahead and get started and jump right into it. Again, welcome to the call. I'd like to talk about the investment roadmap and the detours ahead. And this is something that we obviously do every 6 months, and we try to update everyone as to where the markets are, whether we're in a bull market or a bear market, different ideas on stocks, bonds, currencies, and gold, or any other questions that may come up from time to time. Okay, one of the biggest, questions that we always get is, where are we at today? And so on this chart, although it may be difficult to see, you can kind of see a slope up there to the middle and then a slope down. And what this is the price to earnings ratio of the S&P 500. The S&P 500 is basically 500 of the largest companies out there that trade on the United States exchanges, like the New York Stock Exchange. And what I mean by a PE is price earnings multiple. If company A, and let's just say John Deere, for instance, let's say John Deere made $1 a share, or $1 per every share of stock that they had outstanding, and they traded at a 15 multiple, then their stock would trade at $15 per share. And as you can see in this area that we're in here, we are trading below the average of the forward price earnings multiple. So that means what the earnings that we expect to come out of these top 500 companies, we are actually trading at somewhat of a discount to our historical average. It doesn't necessarily mean that the market is overvalued or undervalued, but in this situation, we would suspect that the market would be somewhat undervalued. Okay? So, maybe another reason for the market to be somewhat undervalued, let's look at our gross domestic product, or GDP. And the GDP obviously is all the goods and services that are available in the United States, and our government accumulates that information. And one of the things here that I look at when I look at the GDP, if you can see the gray lines here, 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 and so on down through the chart here, is that those gray lines indicated a small recession or recessionary times in the market. And typically when our gross domestic product goes negative, it can mean that we enter into a recession. There are times when it doesn't, as indicated by the blue arrows pointing upward in the graph. Okay? So there's only been a couple times, obviously, that you can see from 1960 that we didn't. There's another one right here that we didn't enter into a recession. So right now, from where we are, again, our GDP was negative in the first quarter of 2014. A lot of folks are blaming that on the weather, and we did have a very tough winter here in the United States, and that may have resulted in I guess, a negative gross domestic product. So, however, although earnings were somewhat favorable, as evidenced by the next slide, this basically, the red means that we had, if you're on the top side of the line, it means that companies that reported earnings, and this is over 2,000, 3,000 some companies that reported earnings were actually greater than they were the year before. And then as you can see down here, where the red goes below the line, that means that earnings were less than last year. And obviously the Great Recession of 2008, 2009, we had quite a few of those, and these represent each quarter or 3-month period of time. So right now, as you can see at the very last little red line here, our earnings were actually higher than the previous year. Even though our gross domestic product faltered, earnings actually came in higher. But the dotted line right here through the middle, as you can see here, okay, that's the average. So earnings were actually quite a bit less. Each of these little white bubbles down here at the bottom means that we had a recession. And then there are times when earnings falter that we have basically a soft landing, as they say, out in Washington. So right now we are seeing earnings advance, but we did have a negative gross domestic product. So we're getting a few conflicting signs in the market. But we actually think that because we are still trading below our reversion to the mean, or the price earnings multiple is trading less than history suggests, that there may be some upside in the market left for us. Okay. The other factor that we still believe that the market will perform well in the second half of the year, albeit, I mean, there may be some hiccups from time to time, is ownership in the market is very low. At the highest, we were at 65%, okay, 65%. Now we're actually at 52%. People have not come back to the stock market because of 2008 and 2009. Those periods of time right there really, I guess, maybe scared a lot of folks into coming back to the stock market. So at 52% stock ownership, it remains well below the historical trend of 60% plus seen before 2009. So we believe that, as people come back to the stock market, assuming that they do, that the market will expand its average price earnings multiple, and we will see a higher stock market. Albeit at the start of this year, I must say, we anticipated a 9.5% to 15% stock market rise, and we thought 9.5% was that good number. And as we stand today, as I'm speaking, it's right around 7%, or maybe even a little bit less than that. So, we've gained a lot of those gains in the first half of the year. So it'll be interesting to see how much more we can tack on, if any, in the remainder of the year. But I do believe it will still be positive in the second 6 months of the year. One of the things I'd like to point out, and as some of you may have seen this slide before if you've heard me speak, is the thing on the right, most of you know what that is. It is a Big Mac. That's correct. It's a Big Mac. And I always use this in the springs on the left. The market acts like a springboard. So if you would have bought McDonald's stock in 1972 and sold it in 1982, if I would have told you that the profits tripled at McDonald's over that same period of time, would you have thought that you would have made money on that stock? Most people would probably likely say yes, but the answer is actually no. And the reason is because the market gives us different multiples based on the time that we are in. And I use that 72 to 82 time period because during that period of time, as some of you may know, interest rates were extremely high. Mortgages were at 14 to 16%. Well, now mortgages are 3 to 4%. So the multiples, although they were very low during the 70s and early 80s, now we are in a period of time where multiples are a little bit higher because, quite frankly, I mean, the 10-year Treasury bond, if you were to buy a bond backed by the U.S. government for 10 years, the yield is about 2.5% or 2.6%. It's right in that range. That's not very much. I mean, when it wasn't in the 70s and 80s that it was over 10%. So I just want to share that with you, that the market gives us different multiples all the time. So the question is, are we still bullish on the market? Yes, we are. Yes, we're getting some conflicting signals out of the stock market, but we still are bullish for the remainder of this year and, quite frankly, over the next several years. Although it is not uncommon for the stock markets to correct 10% at a time. And usually those are actually healthy corrections. One, it gives us an opportunity to buy different companies at a lower price. And two, it shakes out some of, I guess maybe I would say kind of the dead weight and actually creates a healthier market as it springs forward. Okay? One thing I do want to point out, maybe from a bullish case, is that the top 100 companies, as you can see, their price earnings multiple on the trailing 12 months is actually higher than our normal average. So that's a little bit of a conflicting sign. And what I like to try to point out there is, and I'll point out in the slide coming up, is that typically speaking, there are different groups of stocks. So there's large stocks and small stocks, and they don't always interact with one another and go up and down the same way. So this next slide, a lot of times right before we see a recession, we see the transports tend to slide downward, like they are here and here. Okay, so here in 2007, that was a good indication that the market was going to falter. And again, in 2009 and again in 2011 when we had another downturn. Okay, but right now, I mean, actually, we're seeing a lot of upside in the market. Okay, so in the transports and the railroads and different companies like that. And typically, the transports signal a decline in the market, and we have not seen that yet. So that's a positive sign right now for the stock market. As you can see here, as I was talking about here's the top 50 stocks. Their sales were up 1.5% in the first quarter of 2014, but the bottom 2,000 stocks were up 7.7%. I think that's an interesting scenario, and as you can see, that's kind of been taking place for quite some time, where many of the small stocks have actually been doing quite well. So again, I still think that's another positive sign for the market. And this graph here, although it's really hard to read, basically means that growth stocks are still a little bit cheap. Some of the dividend-paying stocks aren't any longer. Okay. I'm going to jump real quick here to this next slide. I've been putting up this slide for quite some time. Anytime we have a 10 to 16-year rolling period of time in the stock market where we have a negative performance, it's every time it's indicated an upcycle of 20 to 25 years. So here we've seen that here, where here's a decline of the first decline in the Great Depression of 10 years, followed by a huge upcycle in the stock market, up 569%. Okay, and then once again, 16-year slide downward. Okay, and then followed by a huge upturn in the market, 484%. And then once again, we had the same thing in 2008 and 2009. And again, so here, we're experiencing this big upward period of time, and maybe this one will last for 20 years, much like the last couple. Well, if we think in terms of a 500% return in the stock market, and let's say the S&P 500, went down to 700. Actually, it was 667, but let's say 700. A 500% return would put it at 3,500. That obviously indicates that we have quite a ways to go in the stock market, maybe even another 100% upward, 80 to 100% higher over the next so many years. And even if that's over another 10-year period of time, that's an 8% return on our money. So in simple terms. So I'd say that's a pretty positive sign. I don't see that we're going to get that in the bond market. Okay, so I have to have obviously some ideas for a case for a bear market. So what I did is I kind of put together a red flags checklist, and I would say we would probably be due for correction if the S&P 500 got up to about 2050. That would indicate that we are at a 17 times forward multiple, as I showed on the one slide previous. Right now we are basically underneath the historical average, and obviously there's some other things on here. Whether it be the housing recovery starts to stall, we don't know what the government's going to do, and maybe they create some bad regulations that would cause the market to fall. If we saw some negative surprises out of Europe or Japan under the global indicators here, significant slowing in emerging markets has already happened, or a reversal of the manufacturing recovery. We just don't see those happening. So we're keeping our eye out for some of these things for the market to unwind a bit. And I will tell you that we are due for a correction in the market. It would not be uncommon. It would not be a surprise to us. It would actually be an opportunity to, frankly, buy back into this stock market further than what we are. And as I mentioned in the last slide on the manufacturing, here we're seeing our manufacturing and global manufacturing still doing quite well. So unless it dips under this 50 line, which it did here in 2008, 2009, as we can see there, I still see some positive outcomes for the stock market. Okay. In addition, in 2008, 2009, a lot of folks, even myself, debt was bad. We started getting rid of all of our debt. Corporations did it as well, but in the private, non-financial sector, a lot of folks got rid of their debt. And so we're starting to see people come back to that and starting to borrow money again. And I think that's positive for the economy. Obviously, it probably wasn't, it got a little, ridiculous maybe there at the top of 2008, 2009. But clearly we've swung the other way. Anything in moderation is good. Obviously, excesses to one way or the other are usually greeted with some fear of the markets. Okay. The next slide, as I'm about ready to wrap up, I mean, we don't have a whole lot more. Again, I want this to be quick and informative. And if you have any questions, obviously, your CPA is a great person to ask, or your accountant that you're using, because they'll be able to get you the answers that you need. Typically, nominal gross domestic product growth typically exceeds the level of short-term rates. So right now, our GDP has faltered a bit, but quite frankly, our interest rates are darn near zero. So we have a ways to go. We'd like to see our gross domestic product, our goods and services that we create here in the United States, escalate back up to this average 6.6% line, or frankly, even somewhere between 3 and 5%. We'd love to see that happen. But right now, we do recognize that our 3-month Treasury bill rate is essentially 0%. You're earning no money on your money. So with that being said, we may be in for some tough sledding, obviously, in the economy, but we don't see any big falters either. So it's really just kind of a very slow and sluggish upward trend that we may see in the economy, and then maybe at some point here in the stock market, we may see some returns that are somewhat muted in the mid single digits. Okay. Just a quick funny on the employment situation, although it's not very funny. It says, this is our son, Eddie. He just graduated from school and is entering a void this fall. There's a lot of folks coming out that are still looking for employment. The employment that I use as a guide to our unemployment rate here in the United States comes off of shadowstats.com. And right now, I think we're running around 12% unemployment. Still not very good. We need to get that down to around the 7%, 8% level for a much healthier economy. So obviously, as the Affordable Care Act works through the system, and maybe some other regulations that we have out there, hopefully we'll see some positive signs in employment. We have recently. I mean, the employment has been picking up. The rolling numbers of people employed is starting to move higher, and that is a positive sign. And no matter who is in office, obviously we all want to see greater employment. Okay. This is just a quick chart that I put together saying that, where I expected the stock market to be in 2013, 2014, 15. And maybe some of you have seen this. I've been doing this for quite a few years, and I've updated it all the way through 2017, saying that, where do I expect the stock market to be. I do think that in 2014 it would probably be one of our last decent years, and then after that, I think the stock market will continue to be positive, but maybe muted in terms of returns. We aren't going to see the 30% returns or 15 or 20% returns any longer. Frankly, I would expect somewhere in the single digits, okay, for the stock market. All right. So That's it, really, from Archer Investment Corporation. Again, I wanted to share with you our mid-year update and outlook, and keep it brief and pointed. And again, if you have any questions, please don't hesitate to ask your CPA or advisor that you're working with. We'd love to help, whether it be analyze the statements that you currently have or the accounts that you currently have, and give you our feedback. We have a pretty good system here where we will go through and review statements and make sure that your investments are meeting the expectations that you believe they should be. With that being said, if you have any questions, don't ever hesitate to ask, and or feel free to call us, and we'd be more than happy to help you out. Thank you very much, and I appreciate everyone being on the call. And that is all. Thank you.